Over the next 10 hours, financial market participants are going to ask themselves and each other what Jerome Powell, the chairman of the Federal Reserve, will speak at the Jackson Hole meeting. This, of course, is the mecca of central bankers, and what Jerome Powell says is going to be very closely watched by a hyper-tense financial markets. Is he going to indicate greater hawkishness than what is already priced in, and a lot is priced in? Or will he start looking at some signs of slowdown in the economy? To guide us through what we should expect and how we should prepare for this all-important speech, I have with me two experts: Nathan Sheets, Global Chief Economist, Citi, and Aditya Bhave, Senior US and Global Economist, Bank of America Securities. Gentlemen, thank you very much for staying up for us at CNBC-TV18. Let me start with you, Nathan. What's the base case expectation from Jerome Powell?
This is a tough environment for the Federal Reserve. Not only are they looking at an 8.5% inflation, but the markets are on pins and needles awaiting Powell's remarks. There's been exceptional interest in what he's going to say this time. And he's right at the center of the spotlight, which is an uncomfortable place for central banks. But bottom line here, I think that Powell is going to have to sound hawkish. They've got a lot of work to do on inflation, and it's going to require more rate hikes. They're currently have the rate between 2.25% and 2.5%. And our sense is they're going to have to get that above 4% to start really getting traction on inflation. And I think Powell's got to communicate that he's there. He realizes that there's a challenge and is prepared to do what's necessary to defeat inflation.
But how much is priced in, Nathan? Is 4% plus priced in or something less?
It's the market's priced in somewhere, and it varies a little bit, but around the mid threes. So we are, in our expectations, a little bit more hawkish than the markets, but the markets are expecting more. And the question is, well, in the event, how much more than what's being priced in or even that we're expecting may the Fed need to do to get its arms around this extraordinary inflation that we're seeing?
Okay. Well, Aditya, a similar but a kind of a double question to you. What's the base case that you're going with, and what can be the worst case for the markets from Jerome Powell?
Right. So I think the broad message from Powell will be clear. As Nathan said, inflation's unacceptably high. The economy is still on firm footing, and all of that means that rates have to continue to rise. The Fed has to move into restrictive territory, and there will be no quick pivot to rate cuts. So he's going to push back against market pricing of rate cuts. The narrow message around the size of the September hike, I think, could be quite interesting, a little bit harder to decipher. I don't think he's going to give a clear message there because he said the Fed will be data dependent, and we obviously have the the August jobs report as well as the August CPI print in September before the September FOMC meeting. So to answer your question, I think the most hawkish scenario for markets would be if he made a very clear nod towards 75 basis points in September, then I think they would have to reprice not only September, but the forward path as well. That being said, that's not our base case. We still think the Fed will go 50 in September, and we don't think Powell will show a strong commitment to either choice, 50 or 75 tomorrow.
Okay. You said that they will push back against rate cuts. Now, the market's refusing to believe that a rate cut is not there in 2023. It seems to be priced in. You think he could, very emphatically get that notion out of the market, Aditya?
I don't think he can get it fully out of the markets. He can reduce the number of cuts being priced in, but the markets are always going to retain a risk premium of rate cuts because remember, market pricing is the weighted average of various scenarios. And one of the scenarios that markets have to consider is that we do go into a relatively painful recession. Again, not our base case, but it is a scenario to consider. And in that case, there could be Fed cuts. So the markets will retain that risk premium of Fed cuts, but he could reduce the extent to which cuts are priced at the moment.
Okay. Nathan, the same question to you, since you anyway are starting with an expectation of a 4% Fed funds rate, more than the market. Do you think he can emphatically push back the notion or push out the notion of a rate cut in 2023? And if he did that very explicitly, will that impact the market?
I think that Powell's going to focus on underscoring his determination to do what it takes. I don't think that they want to be in the business of managing the futures curve too aggressively. But as he articulates his concerns about inflation, I think that there will naturally be knock-on effects into the market pricing. At the end of the day, I do think that there's a point of confusion in the market, and that is that the market seems to have the view that if the economy starts to slow, that the Fed's immediately going to pivot to rate cuts. And I am skeptical of that. I think that the Fed, in addition to a softer economy, is going to need to see some meaningful traction on inflation. And maybe that's the message for Powell, if he wants to press back a little bit, is that, look, before we can seriously think about cutting rates and probably even think about pausing, we need to see a lot more progress on inflation. We need to see it coming down.
Okay. Time permitting, I'll come back to the inflation part. But Nathan, we don't discuss quantitative tightening enough. Do you think he can put that on the table and that could be the surprise?
I think that there's a chance. That's certainly part of the monetary policy mix at the moment. However, I think that the Fed prefers to talk about the QT as little as it possibly can. And I think the reality is the Fed just doesn't know how that part of its monetary policy mix is going to proceed. They don't know what those effects are. They just don't have a lot of experience with balance sheet wind down. So I think that his focus tomorrow is largely, probably primarily going to be on the policy rate tool. There's a chance that he also talks about balance sheet, but I would think that that would be at most kind of a secondary part of his remarks.
Okay, Aditya, turning that quantitative tightening a bit, up until March of 2020, the Fed's balance sheet was what, 4.5 trillion, and it became nearly 9 trillion in the following 20 months. What have they said in terms of reducing? Hardly, 7-8% of that 9 trillion balance sheet. You think that's an error? And you think, again, will he try and speak about it at Jackson Hole?
So I agree with Nathan that QT is not going to be a focus. They've already started doing QT. They're most likely going to double the pace of QT in September. And I think after that, it's just set it and forget it until there's a reason to stop. And there's a couple of reasons they might have to stop. One would involve if they actually do pivot to rate cuts. Another might be if there's some sort of liquidity issue in markets. But until they get to that point, the amount of QT they're doing relative to the size of the balance sheet, like you said, is relatively benign. It's about $1 trillion per year, roughly, off the balance sheet. So at least in the near term, it's not something they're going to focus a whole lot on. It's just something that will continue in the background.
Okay. I don't know if you all heard Richard Thaler yesterday on CNBC. And, speaking about inflation, he seems to say that the team permanent inflation are declaring victory too soon. That was interesting. Aditya, what's your sense that outside the Jackson Hole speech, do you think inflation is going to surprise us on the upside in, say, 23, 24?
Right. So I don't think of it as permanent versus transitory. I think the easier way to think about it is supply versus demand. And supply factors are showing some signs of easing. Whether you want to call that transitory or not, I think is besides the point. So we should get continued help from supply, which will show up in goods inflation over the next several months. The problem is that as long as the economy holds up, as long as we get good news on the macro data, there's an increasing risk that demand-driven inflation continues to accelerate. There's recent research written by the Fed that suggests that demand is playing a big role in the inflation that we're seeing already. So that could pick up, and that would make the Fed's life more complicated. So in some senses, good news is bad news at the moment.
Okay, yes. Well, Nathan, what about the dollar? We saw the fall to 104, 105, I mean the DXY, and then we see it again back at 108 plus. In the weeks to come, should we be prepared over 110, or is this about it?
Steroids, with the U.S. economy looking stronger than many other economies, at least amongst the developed markets, and with the Fed biased toward more rate hikes, it's likely to support further dollar appreciation. Now, this is moving into a range that I would characterize as historically quite strong for the dollar. But it could go up another 3, 4, even 5% by the end of the year under these circumstances. That, the U.S. at the moment is looking like something of an oasis of macroeconomic, if not strength, at least relative strength and stability. Okay.
All right. So we should be prepared for dollar strength. A final question to you, Aditya. How about emerging markets? A lot of markets like India, Indonesia have done a better job of curbing inflation. We have seen funds coming back to emerging markets. What is your sense about the rest of the year? Do you think emerging markets stand a better chance?
Right, so that I think will depend in part on the trajectory for risk assets, which in turn depends on how the markets price, I would say probably the terminal rate for the Fed, right? That's a simple way of thinking about where risk assets are going. And the risks to the terminal rate right now are probably to the upside, which means risks to equities are to the downside. Our equity strategist, Savita Subramaniam, has a year-end target of 3,600. So on the S&P 500. So downside risk to U.S. equities probably is, upside risk to the dollar, and both of those mean negative risks for emerging markets.
All right, that's very important. Our viewers will be watching that number very closely. Thank you very much, Aditya Bhave and Nathan Sheets, for staying up for us. We will know in a few hours what Jerome Powell has on his mind, and the markets will have to ruminate over it over the weekend. Thank you very much for staying with us on It's the Economy. Chartbusters up next.
Thank you.